howdy there folks, and welcome into today's video. I'm Jeremy. This is a financial education channel. Today we're going to get into a subject around getting free money for investing, essentially, all right? And I think today's video is going to be extremely powerful for folks that have been investing for a while, and really this video is going to be extremely powerful for folks that might be newer to investing in general, and even intermediate folks. I think you guys will enjoy this video as well, okay? We're going to go through 5 different people here in 5 different scenarios. And what you're going to find is there's certain things you have to do that are going to put you way ahead of the ball financially much faster. And if you don't do certain things, you're going to likely be way further behind the ball. What does it mean to be further behind the ball? It's not really like keeping up with the Joneses. Let's try to have a bigger house than my next door neighbor, or let's try to have the better car or something like that. If you want to play that game, fair play. You play whatever game you want, right? But really, at the end of the day, it's about not having to worry about your bills, right? It's about being able to live life on your own terms, retire when you want to retire, be able to help out folks that you want to help out, things like that, right? That's what really adds up in the end. So, Person A, and by the way, I hope you enjoy this video as always. All I ask in return is that you smash that like button for me educating folks today on this, and that's about it, okay? Person A here, okay? They start at age 35 with investing. Now, I would say of people that start investing, and keep in mind, most people don't start investing. So the fact that an individual actually starts investing is a huge step in the right direction. Let me just be very clear about that. Huge step in the right direction. But when people start thinking about investing, a lot of times they're already in their mid-30s, right? A lot of folks, in their 20s, they're not even their conception of investing is just not even there. They can't even conceive the fact of investing money, right? And then a lot of folks start having kids, late 20s, early 30s. You start having all these financial burdens. Maybe you're making less money, right? Keep in mind, a lot of folks least earning years are their 20s, and they start earning a lot more money in their 30s, 40s, and I believe they peak out somewhere in their 40s or 50s as far as their income potential, right? And so imagine this person is the average person. They start investing at age 30, all right? Well, if they started with an initial deposit of $10,000, they add $500 a month, which is definitely not a crazy number, $500 a month. They do that over the next 20 years, and they just put their money in an S&P 500 index fund, which is essentially like giving yourself free money. You don't have to work for it. You don't have to do anything. You essentially just put your money in an S&P 500 index fund. Fidelity has a phenomenal one. Spider has a really good one. Vanguard has a phenomenal S&P 500 index fund. You stick it there. You'll get around 8% per year. Some years you're going to do better than that. You're going to outperform. You might get 20%. Some years you might do worse than that, okay? But on average, you should get about 8% roughly per year. That's how the averages have gone for a long time now, okay? Your future balance at age 55, so 20 years later, is $321,000. So, first off, all that green there, this is all money you're basically just getting for free, essentially. All you have to do is have your money over there in that S&P 500 index fund. Not bad for basically doing nothing except putting some extra money over there, right? And to have $321,000 at age 55 is nothing to sneeze at. Like, that is really solid. What we're going to find as far as, when we go into some of these future folks here is that, man, do the numbers really start getting big if you're going to do certain things, all right? Now, look at this one. This is an interesting one. This is person B, all right? Now, this individual, they start investing at age 25, all right? So they start 10 years earlier than that last individual, right? The other person started at age 35. This person starts at age 25, right? They start with half the amount of money. Remember, the last person we did, they started with $10,000. This person's only starting with $5,000 here. They do the same contributions. Only difference is now they have an extra 10 years to play with, right? They get the same amount of return. They just stick it in an S&P 500 index fund. They get their 8% roughly per year on average. This person, now at age 55, is at $730,000. That's over 2x, over twice as much money as that last person had. And here's the thing. They started with half of the amount of money that the last person had that initial deposit of $10,000. They started with only $5,000 and matched the same exact contributions. So what this should teach you is, man, the younger you get started, the better, all right? The most important thing from the first slide was, hey, you know what? Get started. Like, invest. It doesn't matter what age you are. Start investing, right? This slide should teach you, the younger you get started, the better you're going to be, right? Okay? Now, look at this person, all right? This person They started at age 25 as well. This is person C here. Now, they put half their money into index funds. That Fidelity Fund, Vanguard, the Spider S&P 500 index fund that just tracks the S&P 500. By the way, the S&P 500, as far as index funds, they're kind of rigged in your favor because essentially the way the S&P 500 is factored, essentially, they kick out the stocks that aren't doing good out of the S&P 500, the companies that aren't doing good financially, and they bring in the best ones. So it's kind of rigged in your own favor if you're wondering, like, how does this work? Why does it get on 8%? And as those companies get bigger and bigger, more profitable, guess what? You thrive in that, right? And then a company does bad, they kick it out of the S&P 500, and new companies that are thriving come in. So it's kind of rigged in your favor, right? So that's why it's so powerful, right? So person C, they started at age 25. They put half their money in index funds and they put half their money in individual stocks. And throughout that time, they're able to outperform the market when it comes to their individual stocks. So since half their money was over there, half their money was in an index fund, they average out at about a 12% return per year. Now, keep in mind, if they're investing in individual stocks, they're actually doing research. They're putting in research work, right? So it's not as simple as just buy an index fund, put some money over there, and boom, you're good. Now they're actually trying to listen to some conference calls. Maybe they're doing that through the Hungry Bowl app, which is on iOS and Android. If you haven't checked out Hungry Bowl, it's a way to track your stocks, track your cryptos, read our daily newsletter in there. It's all absolutely free. Listen to earnings calls, plus so much more coming down the road. So this person, they're actually putting in some work, right? And so they are able to outperform the market at basically at age 55. This is supposed to say 55 here, not 25. They have $1.6 million at age 55. $1.6 million at age 55, right? That in itself is an impressive feat. So now we're talking about they over 2x the last person, only on the fact that they pick some individual stocks and they outperform the market with those stocks, okay? Person C, looking real good. What about person D, all right? Well, person D, they also started at age 25. They are all stock picking. Now, they have been doing it for so many years that they just keep getting better at stock picking. They just keep getting better at running their portfolios, right? Because keep in mind, everything you learn in the stock market is cumulative. So meaning, like me as an investor, I started when I was 18, 19 years old, right? Me today recording this video in front of you at age 31, I can tell you I am so much better of an investor here at age 31 than I was at 18 and 19 years old. It's like night and day, right? And so this person just kept getting better and better over the years, and they're actually able to get a 16% rate of return on average. Now, keep in mind, 16% is definitely very, very good in the stock market. This is not like the best number we ever heard or something like that, okay? So you get 16% on average, very, 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 very good, but not something like, wow, we've never heard of somebody doing this. So I think that's important just to factor in, like, is this something that's ever been done? Yes. Plenty of people have averaged 16% on average, okay? This person, same initial deposit, same contributions, right? $3.6 million. They just over doubled up the last person just based upon the fact that they get 16% on average versus the last person got 12% on average, right? So, I mean, we're talking about such crazy numbers when you really start viewing this, right? Now, in school, Fs were usually meant that, you get the worst grade. Well, in this scenario, person F, you're going to see they got the most magical of all this bunch, okay? If you're really going to pick a person, be person F, okay? If you're in school, don't get an F. But if you're in financial world and you're in financial life, be person F here, okay? Because this one's the most powerful, and then I'm going to give you a few takeaways from this video, okay? Person F, they start at age 20. They're the youngest of everybody, right? They go all stock picking, right? So they start with their $5,000 initial deposit. Now, this person also does bigger contributions. They do $1,000 a month, which is $12,000 a year, right? They have 35 years of time horizon before they hit age 55, since they're starting at age 20. They get that 16% return, which once again is a very respectable return. Very, very good, strong return. But definitely a lot of investors have done that before, right? Over $14 million this person has at age 55. Over 14 mil. Keep in mind, this is not a crazy amount they started with. They started with $5,000. This is not a crazy amount in contributions. It's not like this person's making $2 mil a year and their contributions on a monthly basis is like, $35,000, something like that. It's $1,000 a month, right? Nothing crazy here. Really, really solid return, but they have 35 years to play with, and now they got 14 mil. And look at the interest. And imagine as the years go on more and more. Imagine by age 60. I mean, they have such a fortune that they have built now generational wealth, if that's what they wanted to create, right? For their families, to change their families forever, right? Or if they want to, give a ton of money away to charities and things like that, they have that sort of money that, as the years tick on and all of a sudden they hit age 60, 70, they're going to be able to do whatever they want. Their life is made up. Like they can do literally whatever they want, right? But also as these numbers get bigger and bigger, they can leave a legacy behind them, which is, I think, a really, really powerful thing for some folks out there, okay? So person F, my gosh, are they in a great financial position, all right? So if we learn something from today's video, time is important. The younger you can get started in taking investing serious, the better off you are. The amount of money you put in on a monthly basis is very, very important. The more money you can put in, guess what? The better return, or the more money you're going to have at the end of the pie, right? And the rate of return, extremely important. If you can get better than the market does, you're going to do pretty darn well. And don't be sucked into the mindset that some folks are that you can't outperform the market. You can absolutely outperform the dang stock market. I can promise you that. As long as you're willing to put in the work and you got the stomach for it to hold through tough times when things get rough, there's plenty of money to be made in the stock market. Believe me on that. I've seen it time and time again. I've been fortunate to, coach hundreds of people that are now 6 figures, 7 figures, 8 figures in the stock market now in stocks, okay? So that is what equals investing success. Hope you guys enjoyed this video. As always, if you want to learn directly from me and check out our brand new course, How to Invest Like a Pro in 24 Hours or Less, check out the pinned comment down there and apply for that, guys. Hope you enjoyed that as always. Much love and have a great day.